Chargepoint is making huge strides towards profitability. So in this video, I'm going to review the steps that Chargepoint took in its most recent quarter to get closer to achieving profitability on the bottom line. So let's get right into it. So in its most recent quarter, non-GAAP Q1 gross margin was 25%. That was up from 23% in Q4 and up from 17% in Q1 of last year. So big jump upward in terms of non-GAAP gross profit margin. This improvement, management says, was primarily a combination of diminishing supply chain and logistics expense pressures and operational improvements at better scale. So the first part of that, supply chain shortages and higher shipping costs have moderated significantly year over year. Remember, this same time last year, shipping expenses were extremely high. So that's off the table now. That's been lowered almost by 2/3 compared to last year, and supply chain shortages are easing, so companies like Chargepoint are no longer having to pay premium prices to get the materials that they need for their production. So that's excellent. That temporary headwind has faded. Second, the operational improvements. They're learning, right? They're growing. They're a young growth company. As they grow every quarter, they learn something and they make those improvements and they get better. And I like to see that improvement in their gross profit margin. And then, of course, economies of scale. This is where companies have a base level of fixed costs, and then as revenue grows, it just delivers better profit margins because your fixed costs don't increase, right? These are things like rent, right? Typically, if you have a manufacturing facility or corporate offices, you sign a 3-year lease or a 5-year lease, whatever it might be, and that rent is flat, right? $10,000 per month or whatever it is. And so as your sales grow, your rent stays the same, and that delivers some expansion in profit margin. And labor is another thing, right? You have employees, you pay them a fixed wage. If your revenue increases, that delivers economies in scale. And so it's good news that Chargepoint is seeing this. And this was impressive here, this next point. Non-GAAP operating expenses in the first quarter were 85 million. This was just a 2% increase compared to the same quarter last year. Just 2%. This is for a company that's growing over 50% in every quarter while its operating expenses are staying flat. That's excellent. Excellent performance there. I don't like to see companies growing their revenue and then their expenses are growing even more than their revenue, right? So they're having to spend a lot of money just to grow their revenue. That wasn't the case for Chargepoint in its most recent quarter. I like to see that. So for the rest of 2023, they will continue to manage expenses carefully, and they expect to deliver improvements in operating leverage throughout the year. That's excellent news. Looking at their cash, they finished the quarter with 314 million. This was down from 400 million in the previous quarter, so they burned through 86 million, even more so because they raised more money from a stock offering. So they're still not profitable on the bottom line, and they're not cash flow positive. So every quarter that goes by, they're burning through cash. And so these improvements in profitability are big news for Chargepoint, because the sooner it can reach profitability and cash flow positive, the sooner it can reach a sustainable level where it's not negative cash every quarter. So finally, for the second quarter, they expect revenue in the range of 148 to 158 million. That would represent a 41% increase at the midpoint. But more importantly, they are committed to being adjusted EBITDA positive in the fourth quarter of calendar year 2024. So in about a year and a half, the company expects to be positive in terms of adjusted EBITDA and cash flow positive by then as well. So if it does achieve that feat, that means the company's on a sustainable footing, right? If it's cash flow positive, that means it can self-fund. It doesn't need to go to capital markets and sell more equity, dilute shareholders, or it doesn't need to go and borrow money. It can just support itself and continue growing without tapping into capital markets. All right, so there you have it, the huge steps Chargepoint is making towards profitability, with the big goal at the end of 2024. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.